Hey everybody in Hawaii, it's Dave Lindahl here, and I'm really excited to be coming down there on December 10th for that one-day event. And I'm really looking forward to meeting everybody. And if this is your first time at the Real Estate Investment Association there in Hawaii, you're doing probably one of the smartest things you can do, and that is become a member of your local real estate investment group. Because when I started investing 17 years ago, the one thing that really kick-started my career was the fact that I could go to my local real estate investment group here in Boston, Massachusetts, and I could see people that were just like me, that were out there doing what I wanted to do, and they were being successful at it. And better than that is I was with a network of people that understood me, that were going where I wanted to go, but more importantly, I was in a network of people that could mentor me. And that's what RIAs are all about. So if you're new here, join and keep coming back. So I'm coming down on December 10th, and I thought I'd give you a quick preview. Right now I'm actually going to teach you something right now. It's only going to take a couple minutes. And then during your next meeting, I'm going to teach you something else. I'll tell you about that in a minute. So, you know, I'm all about multifamily properties. I love investing in multifamily properties. I started with nothing 17 years ago. Started out really slow for 3 years, only bought 3 to 6 unit properties, and then started buying bigger properties. So I now own over 7,000 units all around the continental United States. So what I thought I'd do is I share with you in this small segment on how to analyze these deals. Now, some people think it's complicated to analyze a multifamily deal, and it's really not. It's just understanding some numbers. You know, the primary number that we're looking for as investors is what is the capitalization rate, okay? And the capitalization rate can be very confusing. So what I did is I took a very confusing number, broke it down to a very simple number so that I could understand it when I first started out, and I think this will help you as well. So I call this the times 10 valuation calculation, by the way. And what you do is you take the yearly income of the property, okay? You subtract the yearly expenses, not including the mortgage, okay? We're going to use that mortgage for something called a cash-on-cash return, and I'll explain that in a minute as well. That's going to give us our NOI, or net operating income. As investors, we're always looking for ways to increase our net operating income, because when we increase our net operating income, we increase the cash flow of the property, which means we increase the value of the property. Because the value of our multifamily and commercial properties is all based on cash flow. All right? It's not based on what the property itself, it's based on the cash flow from the property. So we take that NOI, we multiply it by 10, and that gives us the approximate value of our property. Now the picture that I'm showing you here is actually the picture of the very first deal I did 17 years ago. It's 125 Newton Street in Brockton, Massachusetts, which is a very blue-collar community. You could say blue collar, I was about to say seedy community. What happened in Brockton is all the manufacturers left Brockton. They went overseas back in the 60s and 70s and left Brockton kind of blighted. There were some good areas in Brockton that I invested in, and there was a lot of bad areas, and everybody was really afraid of Brockton. But I saw an opportunity for me because, you know, I was broke at the time, and I wanted to do something that would change my life, and I thought real estate was it, and it turned out it was. So if we put some numbers on this, the yearly income of this property was $34,000. The yearly expenses was $15,300. The NOI was $18,700. We take that $18,700, we multiply it by 10, and that gives us a value of $187,000. Now this is a very conservative formula. If you get a deal that works, if you can buy a property for less than what this formula is giving you for a value, 9 out of 10 times it is a good deal and you should buy it. If they're asking for more, I wouldn't do it. But let's quickly go a little bit deeper into this, okay? And let's take a look at the next step. If we see a deal that we want to analyze, sure, we'll do that quick analysis, but then we'll take the next step and we'll analyze it even deeper. And when we do that, okay, we want to be looking at 3 things. We want to be looking at the cap rate, the cash-on-cash return, and the debt coverage ratio, the 3 most important ratios when you're investing in multifamilies. Now, whenever we're buying a property, we always want to get a big discount. Okay, the capitalization rate is going to tell us whether or not we get a big discount. We want the property to be cash flowing. We're not going to buy anything with negative cash flow. All the formulas that I'm going to teach you on December 10th are formulas that are going to show you how to buy very, very conservatively. Okay, I'm from New England. We're the Puritans. We're very conservative up there. My father, and plus I'm Swedish. You know, Swedes are known to be very frugal, very trustworthy, and very sexy. That's true. All right, and then the last ratio is debt coverage, the debt coverage ratio. So what is the cash-on-cash return? Well, the cash-on-cash return is very simply is the money that you expect to get on your investment, or the return that you expect to get on your investment. As simple as that. As investors, that's what we want to know. We want to know what the return on the investment is going to be. The cash-on-cash return tells us how soon we're going to get our money back. Now, I don't know about you, but I don't like to put any money into my deals. I like to use other people's money to do my deals. When I first started, I had to use other people's money because I had none of my own money. But now that I have a bunch of money, I still use other people's money so I can control as many deals as possible. That's really important. So if I'm not putting any money in, then it doesn't really matter how fast I'm getting my money back because I didn't put any money in. So who's really concerned about this? Our investors, the people that are actually giving us the money to do the deals. Okay, so the investors want to know how fast they're getting their money back, so they want to know about cash on cash return. And then we have the debt coverage ratio. And the debt coverage ratio tells you how many times your cash flow covers your mortgage. Now, who do you think is going to be most concerned about that? Your bank. Yes, because you're going to get the majority of the financing from the bank, or you can get it all from private money. You can do either way. But most of the time, when you're first starting out, you may have bad credit, or may have had a bankruptcy, and then you get all private money to do your deals until you get yourself straightened out, which would be very quickly in this business. Or you start using the banks for leverage, and that really works. And in this market right now, banks are still lending on multifamilies. They're not so crazy about the other commercial classes, but they love multifamilies. So the bank wants to know how many times your cash flow is actually going to cover your mortgage. So here we go. We got the cap rate for the investor, we got the cash on cash return for the money investor, and we have the debt coverage ratio for the bank. So what do we like to see? Well, I call the next set of numbers the Holy Trinity, okay? Because we want to see a cap rate of 8 plus, we want to see a debt coverage ratio of 1.6 plus, we want to see a cash on cash return of 12 plus. Whenever we can get a deal that fits that Trinity, all right, that means that we've got a deal that we can bring to our investors, and the investors will be happy to open up their wallets, give us the money for the deal, and now we've got a deal that we can participate in with no money down, get cash flow from the deal, get the appreciation in the deal, and it's a very big and get acquisition fees. And acquisition fees are huge. But I'll explain acquisition fees at another time. But this is just a very short tutorial. Next time, I think they're going to give me a little bit of longer time, and I'm going to teach some more, maybe on some emerging markets. But whatever topic that you guys are interested in, I'll be happy to do that. And then when I have you for all day, I'm going to take you step by step through the process, and the leaders of your group are going to tell you about that as well. So Dave Lindahl from Boston signing out. It snowed here the other day. I'm looking forward to getting to Hawaii, getting on a surfboard with Shelly and Gail, and hitting those waves. Yeah, baby.